To introduce yourself.
Yeah.
Sorry.
Yeah, very briefly, Joe Fimbo from TMF, where I'm a IPT Assurance Director, so looking after global insurance tax issues that arise on global programs. Yeah.
Thank you. So what we're going to cover today is, as you might expect, the taxes that a captive may pay, and importantly, the group that is the captive owner, and what taxes they may be subject to, and above all, the very rapidly changing tax landscape that we're in at the moment. Oh, you've got it on the screen, yeah. So we've got here, which might be a bit hard to see for those at the back, but essentially a corporate structure. So a captive owner group with a holding company in one country, perhaps another holding company somewhere further down the chain that holds the captive insurer, and then over to the side another holdco with operating entities underneath. So basically just a very basic group structure. The tax landscape for captives has been evolving over the last several years, and in particular over the last 5 years we've seen a huge amount of change in the corporate tax world as relating to captives. So for the first part of this session, we're going to talk about corporate taxes, the tax i.e. that the captive will pay or the captive owners will pay in their corporation tax returns, and then Joe will cover the insurance premium tax aspects, so that the premium taxes that the captive owner and the captive are accountable for. So we've got on the screen here the sort of quintet of international tax issues that the group tax departments of captive owners will have to think about in the context of their captive, whether they're setting up a new captive or whether they have an existing captive. And over the last 5 years, part of that tax change that's been introduced has really focused on what I would think of as the baseline underpinning that quintet, which is the economic substance laws. So some of you may be familiar with these rules, but essentially the EU, at the behest of the OECD, implemented these laws to require that in specific low and zero tax jurisdictions, there would be a minimum level of substance required. So a lot of captives are housed in low and zero tax jurisdictions, not necessarily for tax purposes. Entire infrastructures around captive management have grown up in those economies, and the regulatory environments in which those captives operate, they may just have a low or zero tax. And therefore, the EU has now mandated that those jurisdictions have in place these economic substance laws. So what those laws essentially say, and they're a corporate law in those countries, so in Guernsey, in Cayman, in Bermuda, those laws would effectively require a minimum level of substance at a holding company level and an operating company level, and they would require outsourced services generally to be provided on island. So that concept underpins then how the group and the captive owner would view the tax of the captive. So assuming that baseline substance is in place in those locations, the group then has to think about, is the captive really resident in that location? Because if it's not resident, by which we mean centrally managed and controlled in Guernsey, Bermuda, etc., then it risks bringing all of the profits of that entity onshore to wherever it might be considered resident. So that's the first one. Usually economic substance laws would help with that. You then need to think about, is there a taxable presence outside of the captive? So are people making decisions on behalf of the captive outside of the captive's location? So the classic scenario would be a group risk team in the head office location is essentially making decisions where to buy insurance cover for the group, and then maybe makes the assumption that the captive will cover part of the risks of the group. And if there's not then appropriate board meetings and risk committees in the captive location, that could risk bringing profits onshore to wherever that group risk team belongs. And then the transfer pricing rules are essentially there to ensure that the premium flows to the captive and the service flows up to the group risk team are all priced at arm's length, so meaning as they would be between third parties. We then have another wave of legislation called the Control Foreign Companies Rules, which would say for the holding companies above the captive, is there appropriate substance in the captive? Is there a commercially rational operating model? Is the premium all priced at arm's length? And if not, some of that profit gets picked up into the holding company level. And then finally, in some countries, the belt and braces, specific anti-avoidance rules, which we have here in the UK, the diverted profits tax rule. So all of these rules have come from OECD principles, and in parts of that guidance, it does specifically call out captive insurance. There's a general phobia amongst tax authorities about captive insurance. They're still thinking from sort of 20, 30 years ago, brass plate on the wall, offshore money box, which we know is not the case, but they need still educating. And that is a lot of the basis of the inquiries we get from tax authorities. So that's a quick canter through of the existing tax rules on the corporate side. But at the moment, we've got a huge amount of change coming. So the OECD is at work again and has been for the last 2 years, now trying to grapple with how do you tax the digital economy. So how do you tax, for example, the likes of a Google if they're accessing clients and customers in jurisdictions where they don't have a taxable presence? That has now morphed into a much bigger project, taxing all industries, looking at tax nexus as a whole principle. Where do you access your customers? And then bringing in this concept of a new global minimum tax, which some of you may have seen the headlines on, and that is currently being very hotly debated, is the subject of a lot of consultation, including in the UK and basically all the inclusive framework of the OECD, which is 140 countries. So these are the two pillars of the new proposals coming from the OECD. The pillar 1 deals with that tax nexus question. So if you're accessing customers in a different location where you don't have a taxable presence, how would that tax authority be able to get some of that tax? And then on pillar 2, this global minimum tax. So the multinational captive owners will be having to deal with these new concepts and, of course, be thinking about all elements of their group structure and those previous quintet of tax issues that we just talked through, and trying to work out how these new pillars will change their tax profile. And in some cases, they will change them a lot. It's very, very political, probably the most politically charged tax change we've seen coming out of the OECD. Very, very complex rules. And in a very unrealistic time frame. So the implementation is proposed for 2023 and 2024 onwards. The US is finding it hard, given their political system, with the Biden administration fully on board backing all of this, but finding it hard to pass legislation through the US House and Senate. And if Biden loses seats in the upcoming midterms, that becomes even harder. But the other jurisdictions, particularly the EU, are now charging ahead and really pushing that we get both these pillars in place. We've got lots of information on the slides, which I think you'll get as part of the material from this anyway. But it's changing rapidly. The UK consultation is well underway, is due to close end of next week, and we would expect draft legislation in the summer. I personally just don't think these governments realise how complex this is going to be, and I expect there'll be hundreds and hundreds of pages of legislation in different countries, all taking a slightly different stance on some of these issues. So in terms of then the impact for captive owners, and what does that do to that picture we were just looking at the beginning. So these rules, particularly around Pillar 2, are what would be the focus for a captive owner in relation to the tax impact for the captive, because this would impact where there is a lower tax rate. So similar to what we saw with the economic substance laws introduced to low and zero tax jurisdictions, these law changes will essentially try and collect a minimum tax of 15% on any jurisdiction in which the group operates where there is a tax rate below 15%. The rules are extremely mechanical, very, very complex. They don't run what I would say a rational sort of computation of the tax rate. It's based on sort of financial accounting metrics, and then the calculation looks at exactly what taxes are paid in a particular jurisdiction. It can lead to some really odd results, but I think it's fair to say in the case of the captive owner and the group structure we were looking at the beginning, in this example, you would see that the mechanical nature of the rules results in a top-up tax being picked up at the top of the chain. So if you are, for example, a UK-headquartered multinational with a Guernsey captive, and that is at a 0% rate, then it's likely that going forward, that 15% top-up tax would be collected in the UK in relation to the captive. If the top company in the group is in the US, then, as we were just saying, the US are finding it hard to pass legislation on this and may not actually legally be able to implement the rules in the way that the OECD envisage, in which case the next holding company down the chain, in this case company B, they may have the taxing right. So you then look at where is that company and how would they view the calculation in the captive. So very complex, still loads of unanswered questions. Basically watch this space. And in terms of what captive owner group tax departments are looking at, then hopefully this gives you an overview of some of the themes they are currently grappling with. I don't know if anyone has any questions on corporate tax before we move on to IPT.
So first of all, thank you very much. This is incredibly interesting, and I appreciate this is incredibly complex, but just one quick question. If the Topco was in Jersey, but you had significant kind of operations in the UK and elsewhere, what would that look like?
Yeah, no, it's a good question. So we've got a similar issue with so part of my job, I look at insurance companies as well as captives. So a lot of Bermuda headquartered insurers as well would be a similar analogy to your Jersey example. Yeah. So in that scenario where the top company doesn't implement the rules, then you go to the next holding company level and look at where they implement the rules. And if nobody does, then someone further down the chain, so in country C, for example, there could still implement and they could still try and pick up the tax of the captive, even though it's to the side of their part of the structure. So it's a bit like whack-a-mole.
Okay. So you can't escape it.
No. Okay, Joe?
Thank you. So, yes, IPT. Let's bring up all of this first. Whoops. So I'd like to spend the next 20 minutes or so looking at insurance premium tax and what that means for a captive owner, what having a captive in your programme means for the insurance premium tax and insurance premium tax compliance. And so I think important to start with some definitions perhaps about what is IPT, what do we mean when we talk about insurance premium tax. Definitely need to look at it in contrast to direct taxes and corporation taxes, which are taxes on profits predominantly or turnover, whereas when we look at IPT, we're generally talking about transactional taxes. So here we're looking at the issuance of a policy, the payment of a premium, and the tax that is going to therefore arise because that policy has been issued or that premium has been paid. There has been a transaction of some description. The issues are in the main for a direct right captive. That's where the bulk of the complexities and the questions and the compliance issues are going to arise. But it doesn't mean to say having a reinsurance captive you're going to have no considerations here. So hopefully we'll go through and explore what some of those considerations are. What does IPT look like? Well, there's a number of different taxes which we can throw into the bucket of IPT. In the UK, we have our insurance premium tax, normally 12%. Some exemptions are available. Some covers are taxed at 20%. And that's just straight IPT on your premium, fairly straightforward, not too much to worry about there. When we look at certain types of cover, though, certain types of cover will incur specialist taxes on the insurance. So property cover quite often encourages or incurs a fire brigade charge, which will look at funding local fire brigades. I'm thinking of Portugal, Spain. These are jurisdictions. In fact, even London has a London Fire Brigade charge. So any property insured in central London, you will be paying an extra amount of tax to cover that property, which goes towards funding the fire brigade. Motor taxes, very common. Health insurance taxes. So these various parafiscals which go towards funding specific things, and they're a politically easy thing to introduce by a government because until fairly recently, IPT was not terribly well known. If you suddenly have a funding need, and the French are particularly good at this, what you can do is just introduce a new tax on insurance premiums and nobody notices and you've got your money. Once we move outside of Europe, and start looking at some other jurisdictions, we might find that actually what is taxing the contract is a stamp duty. You have a document, you have some kind of contract, it needs to be stamped. And those sorts of taxes tend to follow a different sort of pattern to premium taxes. They tend to be on the contract itself, they tend to be often fixed fee amounts, they tend to be non-refundable if there's any cancellation of premium. And they quite often don't have insurance-specific treatments. They are broad taxes. They capture all, mortgages through to letters of credit may be stamped. So the way that they apply and the rules don't necessarily make sense in the context of insurance. We've seen some issues with that in Portugal just recently where they've changed their reporting system and it's designed essentially for mortgages, the reporting system. And then you try and put in a global insurance program into that and the taxes are rising and it gets a bit complicated. One other type of tax to consider outside of Europe is going to be VAT. Within Europe, within the European Union, you don't normally have to worry about VAT on your insurance premiums. Outside of Europe, it's quite common that you'll find that it's being taxed. And that's an interesting contrast to the insurance premium tax. The insurance premium tax is not going to be recoverable in the way that VAT is. So on your other purchases, you'll get some kind of recovery of your VAT. IPT is just a cost to the business. And with the rates that we've got across the world, it's quite a significant cost to the business. I'm thinking about Germany, where you have a 19% rate. Netherlands has 21%, Finland 24%. Italy 21.25%. These are significant amounts of tax which are going to be added on top of the premium. Finally, just want to have a brief mention of withholding taxes. These tend, again, not to be insurance specific, but when you're moving money from one country to another, when you're paying for a service from outside of the jurisdiction in which it's being performed, you may have some requirements to withhold tax from those payments. Okay. So location of risk. This is the first question. This is, for me, the most important question when we're looking at insurance premium taxes, is which tax jurisdiction are we going to be looking at? Which tax jurisdictions' rules apply to the premium, to the contract, to the transaction? And in the European Union, and actually also still the UK, because the UK has decided to keep these rules and is currently working these rules into our legislation, it provides a framework for us to identify which jurisdiction can tax that premium. And as we know, there may be, a programme may have multiple jurisdictions, and this helps identify which member state, which country is going to apply its taxes. So Article 157 of the Solvency II Directive essentially says the member state in which the risk is located can tax that premium however they like. It's essentially just giving them carte blanche. You know, the risk's in your country, tax it however you want. So you get huge variations even within Europe of how a premium might be taxed. Ranging from no tax in, say, Romania, Poland perhaps, through to ridiculously complex regimes in France. Article 13 then defines where the risk is located. And those rules are essentially, as we have on the screen here. And you've got to think about what it is that's actually being insured. The first one there is buildings and contents, and this is pretty straightforward. If you've got a building in a jurisdiction and you're insuring it, the premium related to that building is taxed in the jurisdiction of that building. There can be some odd rules about movable property. That can create some complexities, but essentially, where is the building? That's where we're going to tax the premium. Vehicles, again, reasonably straightforward. Where is it registered? You have a car, it's registered in the UK, you're going to pay UK tax on that. You have a ship, it's flagged in Spain, you have to consider the Spanish premium tax regime. The next one is one that I will admit I've never understood. It's an odd little one. It's for short-term travel policies. You just look at where the policyholder actually was when they took out that short-term travel policy. It creates complications if you're at an airport buying insurance, but it's one of the four which we tend to forget, certainly in the context of captives. The last one's the important one, though. All other cases. And in all other cases, apart from those mentioned above, we have got to consider the member state in which the individual has their habitual residency, or if the policyholder is a legal entity, the member state in which the establishment to which the contract relates is situated. Now, it's a bit of a mouthful, but it's quite an important one, as we saw in the Caverna ruling. Now, I cannot talk about IPT without mentioning the Caverna ruling, albeit now, 21 years old. We don't get very many court cases in IPT, so we get very excited when they come along and we talk about them at quite some length. I won't talk too long, but essentially what came out of this was a shift in the way that we were looking at how we're allocating and taxing premiums. The particular case was, I think, for professional indemnity. UK parent company had taken out a professional indemnity policy covering itself and all of its subsidiaries. One of those subsidiaries was in the Netherlands, John Brown BV. In this particular instance, the UK policyholder paid premium to the UK insurer and paid UK IPT. The Dutch authorities jumped up and down and said, well, hang on a minute, we've got a risk in the Netherlands, we want some of that tax. And the court said, yeah, you're entitled to that tax because of these location of risk rules that we have. And that's where that mouthful of the establishment to which the contract relates becomes very important, because the risks associated to John Brown are in the Netherlands. The contract relates to risks in the Netherlands, so that part of the premium has to be taxed in the Netherlands. The court found that it didn't matter who paid the premium, it didn't matter how it was invoiced, whether it was directly to the subsidiary or via the parent. You had to allocate out that premium based on where the risk was. Yeah? Premium allocation responsibilities, great question. It will depend. All of my answers will start with, it will depend on which jurisdiction we're looking at, okay? But broadly speaking, it would normally be the responsibility of the insurer that is underwriting the risks. Typically, IPT and those sort of taxes are the responsibility of the insurer. How the insurer comes to that, and so that would then include a direct right captive. How the insurer or direct right captive comes to deciding on that will be influenced by the insured, discussions with the broker, discussions with other insurers, understanding, what is happening typically in the market. Is it usual common practice to be allocating D&O on office floor space? Probably not. Is it more common to be doing it on turnover? Yeah, maybe. So there's no right and wrong allocation. You have to be able to justify it. You have to be able to defend it. But the responsibility typically will lie ultimately with the insurer. Ultimately, the insurer, as the taxpayer, would be the one that would have to answer to the tax office when they asked, why have you not allocated enough to this jurisdiction? So outside of the EU, we have a few other rules to be thinking about. The first one up here I've got is Switzerland, and the Swiss approach is that they just want to tax the whole premium. If you have a Swiss policyholder, the entire global premium is subject to Swiss stamp duty at 5%, regardless of where the underlying risks are. So they take a very different attitude to the European approach, to the EU approach. The good news is that if you don't have a principal policyholder in Switzerland, none of it's taxed. So if you just have a subsidiary there, it won't necessarily incur the tax. And I haven't put it up here, but you may have heard about changes in Germany, which is creating real headaches for German insurers because it is creating exactly this issue of double taxation. They're finding they're being taxed on their premiums in Germany and also the premiums in the UK covering the same risk. I've taken Australia as an example, but there are a number of other countries around the world where you have to think perhaps about which state or province within that country the risk is lying. The Australian rules looks at property located or events that will occur within the state. Now you can see that we're starting to, again, get slightly different rules to the European ones. We're not necessarily getting a consistent approach across the world. Can end up in situations where we have double taxation or potentially no taxation. The USA, on non-admitted insurance, we have the home state rule. Actually, reasonably sensible, essentially says you find one state and you tax your premium in that state. There are a number, it's quite a complex way of working out where that home state is, but one state will tax the premium. Withholding taxes, again, as I said earlier, as with stamp duties, not necessarily taxes on insurance, they're taxes on transactions of some sort or a contract. Don't necessarily think so much about this concept of where is the risk located. Withholding tax is concerned with where the payment is being made from and to. So that can change your tax treatment. As stamp duties equally. Is the contract being executed or used in a jurisdiction? It may not need to be stamped, it may not need to have taxes paid on it until it enters the country and is used in that country. So to maybe give a little bit of life to what this looks like in real life, take a very simple global program, if you like. And under this global program, what we've got, we have an Irish direct right captive, chosen Irish mainly because of the direct right aspect, which brings in more of the IPT issues. We've got then a local policy covering some risks in Honduras, and then sat under the master policy, we have both freedom of services cover across Europe from Dublin and a bit of non-admitted coverage in New South Wales and Victoria in Australia. And I'll go through each of these in turn to look at what the tax implications of these are going to be, what responsibilities will fall on the insurer, on the captive, on the policyholder. So first up, we have our local policy being issued in Honduras and then reinsured into the captive. So we've effectively got two transactions here. We've got the local policy, which is going to be here premium of $10,000. Honduras operates a VAT regime, so 15% VAT added, and then various insurance levies adding another $5.75 to the policy. In this case, the local insurer is going to be responsible for the calculation, the collection, and the remittance of the tax. No, just ordinary insurance policy, no concerns there at all for the local policyholder or for the captive. It's all the local insurer's responsibility. However, when that premium is then being reinsured into the captive or ceded into the captive, you need to be mindful that there's a withholding tax. Now, I've picked Honduras because there are some nice simple tax rates here, fairly straightforward, but this can occur differently in a number of different jurisdictions. So here, you need to be mindful that the local insurer is going to be obliged to withhold 10% of the premium that they're ceding out of the country. So actually, the premium that is going to hit the captive is only going to be, and this is a very simple example because we haven't got any fronting fees, etc., 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 we're only going to get $9,000 coming through to the captive. You need to be mindful of that when you're pricing. Yeah.
In order to not get a shortfall of what the captive receives, can you add that withholding tax to the premium?
Absolutely. So you can gross, and that's something to be very mindful of. I mean, in this case, you would need to make sure that the local insurer is on board with doing that. But yeah, increasing your premium, you have to be careful about not stating it as an increase for tax. It's a higher premium, but you can do that. So in that here, still going to be the local insurer that's going to be responsible for paying and remitting that tax. Captive won't have any obligations in that regards. There may be double tax treaties which you can utilise to reduce or remove any withholding taxes, but that will depend on the domicile of the captive and any double tax treaties that are in place for that. Next up, we've got a non-admitted into Australia, and this gets a bit more juicy. So, in Australia, we've realised that we have exposures in both New South Wales and Victoria, so we have, on some basis, performed an allocation between New South Wales and Victoria, 75-25. In New South Wales, we've got a 9% insurance duty, Victoria insurance duty of 10%, but then because the premium is being paid out of Australia, again, similar to the previous slide, we have this income tax. Because the captive is not in Australia paying income tax in Australia, there is a deemed profit of 10% of the premium being paid out. The Australian income tax rate of 30% is applied. You get 3% withheld. So again, you need to be mindful of this when you're pricing your premium, ensuring that you're not left with a shortfall for the amount of money that's going to come out of Australia. I've also listed GST here at 0%. This is on the assumption that the local insured is going to be GST registered. In this case, you've got a cross-border supply of services. So we're looking at the GST rules which say, okay, if you're supplying cross-border here, we will remove this from GST, because essentially what would happen is you would pay it to recover it. So they just saying, okay, we'll take the shortcut, we won't pay it. If, however, you are not fully taxable, your insurer is not fully taxable in Australia, or they're not GST registered, which may be the case. I've come across it in some instances for certain financial services insureds or medical services which are outside the scope or exempt from GST. They may not be registered. In that case, actually, the captive in Dublin would be required to be registered for GST and pay GST in Australia. One to be mindful of. So a requirement is that you are collecting that information when you're writing that policy. You have to ask your local policyholder, are you GST registered? Have it on record. Yes, they are. Okay, we don't need to charge GST. The final scenario, and this is where it does become a lot more important for the captive, is the freedom of service policy. So that direct right, where you're licensed. Same would apply if it was in the UK as well. Need to allocate your premium out again, as we've done with Australia, depending on where the risks are. And in this instance, where we have got exposures in France, Germany, and Italy, the captive is going to need to collect these taxes, the 9%, 19%, and the total tax for Italy of 22.25, and collect that from the policyholder, calculate, collect, and then ensure that they have their IPT registrations in place in France, Germany, and Italy, so that they can then go on and discharge those IPT liabilities. Now, all three of these countries are monthly filing regimes, so you have to be quick. That means you invoice your premium in January and your local entity is very quick at paying their premium, and they pay it the day after they receive their invoice. You will have to be settling tax in February. Germany and France both have deadlines of the 15th day of the month following the date of the premium payment. So you have to be on the ball. You have to have exceptionally good reporting processes in place to make sure that you can identify that premium, those premiums which have been collected, because it's all well saying, okay, the policy's incepted or we've booked premium or whatever. You need to be following the premium payment to know when they're actually being triggered, making sure you're collecting that amount and then being able to report it through to the tax office in time. That, I believe, was a very whistle-stop tour of some of the IPT issues that can arise, and happy to take more questions or more for Jenny as well.
So one thing that I've often tried to research but haven't been able to find is examples of where people have fallen foul of IPT rules and what the repercussions have been. Could you tell us a little bit about that?
Yes. So, as I said before, it will depend on the jurisdiction and it will depend on the tax regime. You can find yourselves with a tax regime which is very friendly or not very sophisticated. And honestly, they're quite happy to be collecting the extra tax that you've maybe not realised you should have paid. And when you go and make a voluntary disclosure, they'll take the tax. The behaviour-driven process of assessing somebody, say, okay, you came to me, you were open and honest, I'm going to waive any penalties there are or reduce them just to interest. At the other end of the spectrum, you get jurisdictions which actively are going out and auditing taxpayers. The Germans are particularly aggressive here. The Canadians are particularly aggressive here. They're going out. The German authorities are auditing corporate insureds to ensure that the IPT has been paid correctly, either by their captive or just their insurer generally. They notice different trends. So all of a sudden, you don't have IPT as an expense. Where has that expense gone? And particular example I'm thinking of, there was a change in structure in the way that a risk was being underwritten, and somebody had made a mistake, made the assumption that actually because there was a Dutch holding company, we could allocate all the premium to the Netherlands because the Dutch holding company was paying the premium. The German authorities noticed they suddenly weren't getting this large amount of IPT and said, well, hang on a minute, what's happened to this? They went and found it and they got that IPT. And with that, there's kind of the German authorities are no questions asked, 10%, no leeway, 10% penalty straight up of the late tax plus interest. So it can be It can be expensive. Some jurisdictions, Italy allows for a 400% penalty regime on IPT. You have to then go and engage with the tax office and expose yourselves and say you're terribly sorry, and you can mitigate that down. I've never seen a 400% applied. It tends to actually work out somewhere, normally around 12-15%, depending on how good you are at discussing with the tax officer concerned. Okay, that's great. And hand back to Richard.
Good, thanks, Joe. Thanks, Billy. So we'll just get the next closing panel set up in probably 5 minutes max, and in here, and then 4:30 beers or other beverages are available, I imagine. So, and that'll be out there. So we'll give 5 minutes, and then we'll be starting again.